It has been another noisy month of geopolitics, especially in Europe, although as we've seen recently, markets haven't paid too much attention or made too many knee-jerk reactions. Big news was obviously in Germany, where Angela Merkel won her 4th term. However, the rise of the far-right AfD party may make things difficult for her going forward. Now, we've just had the Catalonia referendum as well, and it'll be interesting to see how the Spanish government and the EU react to that in the coming weeks. But overall, the picture's quite healthy from an economic point of view. We've got broad-based growth in the EU, and we've got a slightly stronger euro, although it has come off its recent highs. What we will be interested to see in the next few months into Christmas is this good news all priced in? We've got some of the headwinds that we might see. Emmanuel Macron, he might struggle to get through the reforms that he's trying to get through, both in France and from a more integrated EU. We've got Angela Merkel trying to form her coalition. She may have issues there if she doesn't quite have the majority she did before. And then will the economic growth that we're seeing encouragingly in Europe hold off overall? Central banks are ready to hike rates and withdraw stimulus as we look towards a more normal monetary policy era. Now, there are risks to this, both with currencies and markets, but we think that central banks will go fairly gradually as they're uncertain about how quickly the inflation will come along and whether the underlying economies can support the return to normalisation. So in the UK, yes, we have inflation above the Bank of England's 2% target, and this has now prompted them to talk about an interest rate rise, perhaps as soon as November. Now, we do have growth in the UK. We did have a downward revision this month for the second quarter to 1.5%, but there is growth there. So the Bank of England are certainly talking like they think a slower return to normal policy can be supported by the economy. So for our portfolios, we've increased our sterling exposure. We've seen sterling strengthen over the last month or so as the interest rate expectations have gone up, and perhaps if we get a rise, even as soon as November, this should be supportive in the medium term. Overall, we still have good global growth, we've got good levels of inflation, and we've got good earnings expectation. So this is helping us keep risk broadly in line with where it has been over the last few months. Growth expectations and rising interest rates should be supportive of bond yields, and in a rising yield environment, we perhaps see less of an attraction to dividend equities, and so we're gradually making this change in our equity exposure.